Look at AstraZeneca. In 2010, it teetered on the edge of a patent cliff, staring down a decade of declining revenues and shrinking profits. Fast forward to today, the company is on track to cross $45 billion in revenues this year, making it one of the world's top 5 pharma companies. But what's truly remarkable is how AstraZeneca achieved this growth. It didn't rely on luck, happenstance, or the whims of the market. It engineered its R&D engine to operate with the precision of a portfolio investment fund, transforming the traditionally unpredictable world of biopharma R&D into a scalable, data-driven growth engine. And here's how they did it. 1. They reimagined R&D as a strategic portfolio. Gone are the days of the linear pipeline and the all-or-nothing baits. AstraZeneca systematically analyzed its therapeutic areas, picking winners like oncology, cardiovascular, respiratory, and immunology based on their differentiated risk-return profiles and asset maturity. Oncology, for instance, was given a bigger slice of the pie due to its high unmet need, large patient populations, and potential for differentiated therapies. Between 2013 and 2023, oncology grew from roughly 20% to over 40% of the pipeline. And as a result, oncology now contributes more than 50% of the late-stage pipeline value. This strategic realignment was backed by data. AstraZeneca's Phase 3 success rate rose to roughly 15%, outperforming the industry average of 11%. Meanwhile, over 60 lower potential programs were stopped early, saving hundreds of millions in opportunity cost. 2. Structured externalization. Instead of trying to internalize every innovation opportunity, AstraZeneca went out and partnered. But these deals weren't just strategic, they were deeply analytical. By pursuing collaborations with biotech firms, academic institutions, and other pharma companies, AstraZeneca gained access to the latest science while diversifying its risk. In 2022 alone, over 40% of new pipeline assets came from external partnerships. Consider the co-development deal with Daiichi Sankyo on the ADC ENHER2. This partnership, which gave AstraZeneca full rights to develop and commercialize ENHER2 in most of the world outside Japan, is projected to bring in more than $7 billion in peak sales. And the deal nicely distributes development and regulatory risk between the two companies. Crucially, the partnership was structured using milestone-triggered funding and a proof-of-concept-dependent opt-in, ensuring that capital is allocated efficiently without diluting long-term value. 3. They measured R&D productivity relentlessly. Using KPIs such as time to decision, probability of technical success, internal rate of return, and stage-specific ROI, AstraZeneca operates its R&D engine with the precision of a finely tuned machine. Between 2012 and 2022, R&D productivity improved by 70%. Time from IND to Phase 3 dropped by approximately 18 months across several programs, and internal analytics tools are updated biannually to reflect changes in POTS and risk-adjusted NPV, ensuring that go, no-go decisions are made with the most current information. This disciplined approach enables faster pivots, better capital efficiency, and higher portfolio returns. And finally, 4. Building market confidence. From the beginning, AstraZeneca made a commitment to transparency with investors. The company regularly shares pipeline valuation models with investors, clearly outlining the assumptions and probabilities that drive its forecasts. This approach builds trust and ensures that internal forecasts and market expectations remain aligned. 𝗕𝗜𝗢𝗔𝗏, for instance, was modeled with an 80% probability of technical success and a peak revenue potential of more than $5 billion. This transparency paid off pre-launch as investors gained confidence in AstraZeneca's R&D engine and the company's market cap soared. Over the past decade, AstraZeneca's market cap has increased by more than 250%, far outpacing many of its peers. In conclusion, AstraZeneca's story is a masterclass in how biopharma companies can engineer into a scalable growth engine by blending scientific ambition with rigorous analytics and disciplined execution. For biopharma executives, the key takeaways are clear. Think portfolio, not pipeline. Align your investments to stage, risk, and ROI, just as a venture fund would. Partner with purpose. Externalization should be structured, data-informed, and milestone-driven. Measure relentlessly. Use internal KPIs like POTS, IRR, and cycle time to guide smart decisions. Communicate with conviction. Transparent, data-backed forecasting earns investor trust and fuels growth.